As we started 2024, the signals in the US real estate market were for inventory growth, for sales growth, and for home price growth across the US. At the time, I observed that even if mortgage rates stayed flat, the momentum seemed to be in the cards for broad, slow growth in the market. However, mortgage rates didn't stay flat. They climbed starting January 1. And as of today, March 18, mortgage rates are 30 to 40 basis points higher than they were when we began the year. Rates are off their recent peak of a couple of weeks ago, but the latest economic news has been very strong, and the markets are growing less sanguine about interest rates easing significantly soon. Most of the last year, the most common view was that mortgage rates would fall in 2024. Now that view hasn't materialized yet, and many people are less optimistic that it will. There's a big Federal Reserve meeting this week, and we'll learn more about the future of interest rates then. And I don't have the capacity to predict interest rates. I'm not convinced anybody does. But what we do know is what will happen to the housing market if rates rise from here, and what happens if they fall. Of my initial expectations this year, rising inventory, rising sales rates, rising prices, only rising inventory remains clear at this moment as we finish Q1 with rising interest rates. I talk frequently about how rising rates create rising inventory, and this is true again in the data this week. My other two expectations, slowly rising sales volumes and slowly rising prices, are less compelling in the data now than they were at the start of the year. So let's look at the data. Really, that's what we're watching for. And at Altos Research, we track every home for sale in the country every week. The market changes so quickly, we don't want to wait for a month for the latest data. We track all the pricing, all the supply and demand, all the changes in that data, and we make it available to you before you see it in the traditional channels. I'm Mike Simonsen. I'm the founder of Altos Research, and let's look at the details of the U.S. real estate market for the week of March 11, 2024. The available inventory of unsold homes on the market rose by a healthy 6,600 homes this week, or 1.3%. There are now 22% more homes on the market than there were a year ago. There are 105% more homes on the market now than 2 years ago. That's 250,000 more homes on the market now than when we exited the pandemic boom in March of 2022. So at this moment in 2022, interest rates and inventory had started rising quickly together as the pandemic boom ended. Mortgage rates were still in the threes in early March. By April, they were in the fours, and by May of 2022, they were in the fives. And in fact, this week, 2 years ago, was when we saw the very last of the 3% mortgages. Then, as mortgage rates rise, so does available inventory of unsold homes. And so demand slows, inventory grows. And that's what we can see illustrated here. That's the rightmost red shaded area on this chart. That's the last 2 years of rising rates and inventory rising in lockstep. This chart shows the last decade of inventory trends, and you can see the big green section in the middle that's the pandemic boom when rates fell so quickly, and so did inventory. Now, as the economy remains surprisingly strong, mortgage rates are staying higher for longer than people expected. And as rates stay high, inventory will keep growing. And so I'll say this every week, higher rates means slower demand, demand slows, inventory grows. So there are now 507,000 single-family homes unsold on the market around the U.S. That's up 1.3% from a week ago, and like I said, 22% more than a year ago. While inventory is growing across the country, some markets are far more impacted, and we already have more homes on the market in some places than we did in 2019 or 2020, just before the pandemic. And while some markets are just now growing off those pandemic lows. But nearly all markets are showing inventory growth over last year now, and this is expanding each week. At Altos Research, in the webinar this Thursday, March 21, We'll spend extra time looking at the local markets to see if any are potentially out of balance with too many sellers and not enough buyers. Do we see price correction happening, for example, in Southwest Florida? There are some really interesting regional trends happening right now. So this Thursday, 10 a.m. Pacific, if you haven't already registered for that, you should do so right now. There's a link in the description below. These are limited to 1,000 attendees. We get way more than that who want to join each month. So click that now to reserve your spot in the webinar. That's Thursday, March 21, 10 a.m. Pacific. The takeaway from the inventory chart is that if mortgage rates continue to rise, say to 7.5% or back to 8%, we will see a pretty dramatic increase in unsold inventory. But if rates finally fall, let's say to 6.5% or lower, we'll see consumers act very quickly and this inventory growth will reverse. So lower rates means more buyer competition and less available inventory. This week, 59,000 new single-family listings unsold came to market. The new listings volume continues to run ahead of last year, more sellers than last year. In fact, this week, after including the 16,000 immediate sales, there were 24% more new listings than the same week a year ago. Last year was probably a record low for mid-March. Very few sellers last year. Now, all year long for 2024, we should expect to have more sellers than a year ago, which is a very good thing. So in this chart, each line is a year. The dark red line is this year. The light red line is last year. And so it's really easy to see how we have more sellers each week than a year prior. The light red line last year was ultra low all year long. And as the market adjusts to a new normal of interest rate levels, slowly more sellers are coming back into the market. Note the gray lines on this chart. That's the previous years. It's not that long ago that we would have 70 or 80,000 new listings each week in March, and we're at 59,000 right now. So the seller volume is climbing, but it's not a lot. And I view this as healthy growth. I'd like to see even more, to be honest, because more sellers mean more selection for buyers and more sales that can happen. The takeaway from the new listings data is that we have reliably more sellers than a year ago, and this is a good thing, but we still don't have a lot of sellers, still a third fewer than in many recent years. So nationally, there isn't any sign of oversupply or supply and demand getting out of balance. Maybe there are some local markets that might get out of balance, but nationally, no sign of that. As mortgage rates continue to stay above 7%, demand is pretty slow for homes. We have gradually increasing supply and generally soft demand. As a result, some of the leading indicators for future home sales prices are starting to weaken. Demand is slow, supply is creeping up. One obvious place to watch this pricing transition is in the percent of homes on the market with price reductions. So this week, 30.9% of the homes on the market have taken a price cut from the original list price. That's up 0.5% this week and is now more than a year ago. At the left end of the chart, you can see this year's curve is starting to climb up and ahead of a year ago. A year ago, price cuts were still receding in mid-March, and we had surprisingly strong spring. It's totally normal for the market to have around a third of homes to take a price cut from the original list price. So we're going to watch this slope, this curve for the slope of the curve. Like if mortgage rates jump back, further over 7%, they jumped back over 7% this week. And if they continue to, for example, when the Federal Reserve meets later this week, if the Fed comes out more conservative than it has recently, that could drive mortgage rates higher. And so we can use the price reductions data to view exactly how the market reacts to higher mortgage rates. Over the next couple of weeks, I'm watching to see if price reductions accelerate. Now, the more price reductions happen because homes are on the market now. If rates jump, a few prospective buyers don't make those offers, and therefore a few more sellers cut their price. So this is a pivotal time to be measuring buyer demand. Price cuts are up just a touch this week. And buyers, it shows that buyers are not afraid to hold back when affordability moves the wrong way. So we could see how fragile this market is already. A longer term signal for watching is watching the asking prices of all the homes on the market. If you walk into the U.S. real estate market right now and look around, this is exactly what you see. The median price of single family homes in the U.S. now is $435,000. That's up a notch from last week. It's just 1.2% higher than a year ago. Again, back in January, I expected price data to be accelerating a little bit more quickly than it has. That's the dark line on this chart. Home prices peak each year in June with the peak seasonal demand weeks. But before they are then receding a bit in the second half of the year. At Altos, we don't seasonally adjust the numbers. We're just counting everything. So this is a direct representation of the U.S. real estate market. And you can see how last year's June peak didn't surpass the all-time high of 2 years ago. So the question now is, will we surpass that all-time high this year, or will it get delayed until 2025? The median price of the new listings this week inched down fractionally to $419,900. The new listings cohort is 5% higher than a year ago. That's the bright red line here. The new listings are an excellent leading indicator for future home sales prices. The sellers and listing agents use all their collective wisdom, and in aggregate, they know exactly where to price each new listing. So what this data tells us right now is that across the U.S., we have just narrowly increasing home prices this year so far. The signals are slightly weaker now than the data at the beginning of the year led me to expect. Slightly weaker now. Now, at the same time, this week saw 66,000 new contracts for single-family homes started. That's 15% more than the same week a year ago. Since mortgage rates have been on the rise this year, sales have been just barely above last year. So this week was probably a bit of an anomaly, but it is welcome nonetheless. Anytime sales growth, it's good to see. When we look at the price of the homes in contract but not yet sold, so these are the pendings, which is what we're looking at here, we can see that home sales prices are coming in about 4% higher than a year ago. The median price of all the homes in contract right now is $389,000. Home prices ended 2023 at 5 to 6% gains over the previous year. So home price appreciation is compressing as mortgage rates have risen. So this chart shows us 3 years of pricing in the pending home sales. And I like this measure for home prices because it's the earliest proxy for sales that will close in the future. So for example, right now we're looking at sales for April. And it shows us that prices, you can see in this chart, the prices adjusted lower in July of 22 and October of that year. Last year was mostly catch-up. So because prices fell at the end of 2022, they showed year-over-year declines in the second quarter of last year. And I've highlighted that section in gray, that time in gray. So, but you can see how last year's red line was lower than the previous year and then didn't resume growth until late in 2023. So now we're ahead by 4%. But if mortgage rates jump from here, we can see this leading indicator show exactly how these gains are fragile. So if rates stay steady around 7%, I don't expect much price correction lower. If mortgage rates jump from here, I expect that to see a step down in home prices like we can see here in October of 22. That's the light red line here towards the right end of the chart. And there was that moment where we had that unexpected rise in rates at the end of 2022. It happened in September 15th. And by October, we could see consumers had stopped buying and the homes that were going into contract were going in at a discount. So keep your eyes on the pending sales prices right now. These are pivotal weeks for the housing market. There are home buyers and sellers sitting on the sidelines, waiting for conditions to improve, and yet conditions haven't really improved. Mortgage rates have kind of stayed up and maybe heading higher. So if potential buyers and sellers knew the data, how would they act differently? Like if you need to help buyers and sellers see the data, you should join us at Altos Research. Go to altosresearch.com, book a free consult with our team. We'll help you know how to talk about the local market with your clients and prospects today. There's a link in the description below. Click that to join us. Let's get started. Thank you.